So, you want to dive into the world of investing? Perhaps you've saved up some money, and while it might not be enough to buy a house just yet, you've decided it's time to put it to work. This guide is here to walk you through the basics of investing, providing insights into the various options available, and addressing common concerns. Welcome back to the Finance Homefront with me, Bev, and today we will break this down in parts. Part 1. Investing Philosophy and Basics. To get started, it's essential to understand the philosophy behind investing. The main goal of investing is to make your money work for you. You've likely heard about inflation, which erodes the purchasing power of your money over time. By investing, you can combat inflation and watch your money grow. There are two primary ways your investments can generate returns: capital appreciation and income. The first involves buying assets, like stocks or real estate, that you hope will increase in value over time. The second is when assets pay out regular income, such as dividends from stocks or rental income from real estate. Part 2. Stocks and Shares. When you're a beginner looking to invest your hard-earned money, stocks and shares are a common starting point. But what exactly are stocks and shares, and why should you consider investing in them? First, let's clarify the terminology. The terms stocks and shares are often used interchangeably, but there's a subtle difference. A stock represents ownership in a corporation, and the entire market is divided into stocks. On the other hand, a share is a single unit of ownership in a particular company's stock. For instance, you might hear about Apple stocks, which implies you're discussing Apple Inc. as a company. In contrast, when you mention Apple shares, you're specifically referring to the individual units of ownership you can buy in Apple Inc. When you invest in stocks or shares, you're essentially purchasing a portion of ownership in a company. Companies issue shares to raise capital, and investors buy these shares to participate in the company's growth and success. For example, if you buy 100 shares of a company, you own a fraction of that company. This ownership entitles you to certain privileges, such as voting in shareholder meetings and potentially receiving dividends, which are a portion of the company's profits distributed to shareholders. The key reason why stocks and shares are attractive to investors is that, historically, they have shown a positive long-term growth trend. Even though stock markets can be volatile in the short term, they have demonstrated an upward trajectory over extended periods. This makes them a viable option for building wealth over time. However, the stock market can be intimidating, especially for beginners. Picking individual stocks and managing a diversified portfolio requires a level of expertise. This is where index funds come into play. Warren Buffett, one of the most successful investors of all time, often advises beginners not to try and pick individual stocks. He suggests that the average person may not have the time, knowledge, or resources to consistently beat the market. Instead, he recommends investing in low-cost index funds. An index fund is a type of mutual fund or exchange-traded fund, or ETF, designed to track a specific stock market index. In the US, one of the most famous indices is the S&P 500, which includes the 500 largest publicly traded companies. An S&P 500 index fund aims to replicate the performance of these 500 companies collectively. The advantage of investing in index funds is their simplicity and diversification. Here's how they work. When you invest in an S&P 500 index fund, your money is spread across all 500 companies in the index. Your investment is proportionally allocated based on the market capitalization of each company. For instance, if Apple is a more massive company than others in the index, your investment will have a higher allocation to Apple stock. As the index changes or evolves, your investment in the index fund automatically adjusts to reflect those changes. Investing in an index fund like the S&P 500 means you're effectively investing in the entire US stock market. This diversification reduces risk because the performance of one company won't significantly impact your investment. Index funds have consistently outperformed most actively managed funds over the long term. they provide an opportunity for beginners to achieve competitive returns without spending excessive time researching and managing individual stocks. Part 3. Common questions and concerns. When it comes to investing, especially for beginners, several common fears, concerns, and questions often arise. Let's address some of these. Fear of losing money. This is one of the most significant concerns for novice investors. There's always the risk that the value of your investments may temporarily decrease due to market fluctuations. However, history shows that, over the long term, the stock market tends to rise, making losses recoverable. Minimum investment. Many beginners wonder how much money is needed to start investing. The good news is that you don't need to be super wealthy to begin. You can start with as little as $100, depending on the brokerage platform you choose. The most important thing is to get started. Timing the market. A common misconception is that you need to time the market perfectly to be successful. However, even professional investors struggle with market timing. Instead, focus on time in the market by investing regularly and holding your investments for the long term. Diversification. Diversifying your investments means spreading your money across various assets to reduce risk. Index funds inherently provide diversification because they include a broad range of stocks. For additional diversification, consider investing in other asset classes like bonds or real estate. Setting realistic goals. It's essential to set achievable financial goals based on your risk tolerance and time horizon. Don't expect to get rich overnight, but with patience and discipline, you can steadily build wealth. Seeking professional advice. If you're unsure about your investment choices or need guidance, consider consulting with a financial advisor. They can provide personalized recommendations and help you create an investment strategy that aligns with your objectives. Remember, the most significant risk for many investors is not the stock market itself, but the failure to invest at all. By letting fear or uncertainty hold you back, you may miss out on the potential for your money to grow over time. Part 4. Fast lane investing, a different approach. While traditional investing in stocks, bonds, and real estate is a solid and widely practiced approach, there's another way to accelerate your financial growth: fast lane investing. Fast lane investing focuses on investments that can provide quicker returns or exponential growth. Here are 2 key strategies in this approach. 1. Investing in yourself. The foundation of fast lane investing is personal development. The more skills and knowledge you acquire, the more valuable you become in the job market. This, in turn, can lead to higher income and financial success. 2. Start your own business or side hustle. Entrepreneurship is another pillar of fast lane investing. Starting your own business or side hustle can generate exponential returns compared to traditional investments. Fast lane investing requires a different mindset. It emphasizes proactivity, creating value, and taking control of your financial future. While traditional investing is often viewed as a long-term, passive strategy, fast lane investing can yield higher returns in a shorter time frame. However, it's important to note that it also comes with higher risks and the potential for more significant failures. Investing is a powerful tool for growing your wealth and securing your financial future. Traditional investing in stocks and shares, particularly through index funds, offer a time-tested method to build wealth steadily. But don't overlook the fast lane approach, which focuses on investing in yourself and creating your own ventures for potentially faster financial growth. Whether you choose the slow lane or fast lane, the key is to take that first step toward building a brighter financial future. Remember that investing is a journey, and the most important thing is to start and stay committed to your goals. What's your favorite investment strategy or your most burning question about investing? Share it in the comments below, and let's keep the conversation going. If you found this video insightful, please give it a thumbs up by clicking the like button below. If you haven't already, don't forget to subscribe and hit that notification bell so you won't miss any of our future content. And if you're new here, take a moment to explore our other content. We cover a wide range of topics, so there's something for everyone. Thanks for watching!